Johnson & Johnson is a dividend aristocrat that is currently trading at $145, and over the past year they are down by almost 10%. Now over the past 5 years they are down by 1.21%, which means that they are currently trading very near their 5-year low. So jumping straight to our stock valuation spreadsheets, let's plug in Johnson & Johnson's ticker and wait for all the metrics to show up. Now as always, if you find these spreadsheets helpful, you can download them at the link in the description. Now right away we can see that the dividend yield of Johnson & Johnson is sitting at 3.43%, which actually for Johnson & Johnson is the highest it has been over the past 10 years. So with such a high dividend yield compared to its historical dividend yield, now might be the best time for dividend investors to load up on this company. But let's first figure out if it's trading undervalued. We can also see that the trailing free cash flow payout ratio of the company is sitting at almost 60%. And this isn't great, as it means that they do have to direct a lot of their free cash flow into paying out dividends and cannot direct most of it into innovation, buying back shares, paying down debt, and raising that dividend. Now normally a free cash flow payout ratio of 60% might not be that big of a deal, but if we zoom into pillar 8 and scroll down, we can see the free cash flow payout ratio has actually been rising over the past 5 years. And what you can understand from this is that over the past 5 years, Johnson & Johnson has been managing their free cash flow less effectively. Now, if we scroll up, we can have a look at the dividend growth of the company over the past 5 years. They have actually been growing their dividend at a rate of 5.33% yearly, which is above average, making the company a great one for investors that want to achieve the dividend snowball effect. Now, the thing you have to understand is that dividends are always paid from a company's free cash flow. So if a company has a dividend growth of 5.33%, their free cash flow should be increasing by at least this amount. But if we jump to the 9 pillars, we can see that Johnson & Johnson has actually been increasing their free cash flow at a negative rate of 2.59% yearly. If we jump to pillar 5, zoom in onto the free cash flow, we can see that in 2020 it was sitting at 19.9 billion, and in 2024 it was sitting at only 17.7 billion. So by raising their dividends but having decreasing free cash flow, the company is essentially going into debt. And that actually brings me on to my next point. Let's check how much debt Johnson & Johnson has. If we have a look at the long-term liabilities over the 5-year free cash flow negative dividends, the ratio is actually sitting in the range we like to see, sitting quite low at only 1.24, which means that with the free cash flow they currently generate and with the dividends they currently pay out, they would take only about 7 years to pay off all their long-term liabilities, which isn't bad at all. And if we zoom in closer to pillar 9, we can see that they have actually been decreasing their long-term liabilities at a rate of about 38%. But now you are probably wondering, if they have decreasing free cash flow, how can they pay down debt while increasing their dividend? Well, there are 2 reasons for that. If we jump back to the 9 pillars, we can see that Johnson & Johnson has actually been decreasing their shares outstanding at a very high rate of 2% yearly. So every single year they pay out 2% less of their free cash flow in dividends. Now the second reason is that even with their free cash flow decreasing, they still have enough of it to buy back shares, pay down debt, and increase their dividends. If you remember, their trailing free cash flow payout ratio is sitting at about 60%, so after paying out their dividends, they still have 40% of their free cash flow to push into the things I've mentioned before. Now what you do have to understand is that this isn't a sustainable model. If Johnson & Johnson keeps decreasing their free cash flow, they will at some point in the future have to cut their dividend. So if you are considering adding Johnson & Johnson to your portfolio, their decreasing free cash flow is something you should look into. Now let's also have a look at the revenue growth of the company and their net income growth. Their revenue has been increasing at a rate of 1.40%, which isn't that high, but their net income has been growing at a rate of 12.57%, which is much better. Something I also like about the company is their high 5-year profit margin sitting at 25.29%, which is well in the range we like to see. And finally, let's have a look at the company's 5-year PE ratio and their 5-year price to free cash flow. If we zoom into pillar 1, we can see that the current PE ratio is sitting at 24.07, which is actually higher than the 5-year average. But this is because year over year their net income dropped by almost 60%. So overall the company actually looks quite fairly valued compared to the earnings they have been generating over the past 5 years. Now let's also have a look at their price to free cash flow, which I do find more important than the P ratio, as the free cash flow of a company is essentially used for everything, while the net income is just a measuring metric. And we can see that the 5-year price to free cash flow is sitting at 21.40 and the current price to free cash flow is sitting at 21. So Johnson & Johnson would be considered very fairly valued compared to the free cash flow they are currently generating. But let's figure out if they are considered fairly or undervalued compared to their future free cash flow. So jumping to the discounted cash flow model, we will plug in the free cash flow over the past 5 years and, as we know, calculate a negative growth rate. Now into the future, I will project a growth rate of 2.3% and calculate the future free cash flow. Now to calculate the present value of that future free cash flow, I have to plug in a discount rate, which I plugged in at 6.3%, and this is essentially the minimum rate of return I would like from an investment into Johnson & Johnson. Now using this discount rate, I will calculate the present value of that future free cash flow. I will add all of it up, add cash and cash equivalents, and subtract total debt to get an equity value, which I will divide by the shares outstanding and get an intrinsic value of $196.87. So into the future, if the company's free cash flow grows at a rate of 2.3%, currently Johnson & Johnson would be considered undervalued. But let's have Johnson & Johnson undergo a few more formulas. So jumping to the grams formula revised, I will plug in the 5-year earnings growth estimate at 7% yearly. And combining this with the 5-year earnings per share, the base PE, the growth rate multiplier, the average yield on AAA corporation bonds, and the current yield on AAA corporation bonds, we will get an intrinsic value of $132.49, which is 10% lower than the current trading price. So compared to its net income, Johnson & Johnson would be considered slightly overvalued. Now let's also compare the company to its peers. So if we take Pfizer, Merck, AstraZeneca, and Novo, and take these companies' current stock prices and divide by their earnings per share, we will get their PE ratios, which when we average out and multiply by the earnings per share of Johnson & Johnson, we will get an intrinsic value of $177.30, which is higher than the current trading price. Now let's also compare Johnson & Johnson to their dividend growth. So if we jump to the dividend discount model and plug in the yearly dividend growth over the past 5 years, we will calculate an average growth rate of 5.81%. Now into the future, I will project a growth rate of 3.5% as I do want to be conservative, and Johnson & Johnson does have decreasing free cash flow. So predicting this growth rate, we will get an intrinsic value of $174.19, which is still higher than the current trading price. Now finally, when we average out these 4 valuation models, we will get an ultimate intrinsic value of $170.10, which is 17% higher than the current trading price. And if we plug in a margin of safety of 15%, we would get an acceptable buy price at $144.58, which is very close to the current trading price. So overall, currently the company seems to be quite undervalued. The only issue I have is that they have decreasing free cash flow over the past 5 years. And so if you want to add it to your portfolio, make sure to do more research on their free cash flow. And with that, as always, if you want to download these spreadsheets, you can do so at the link in the description. Let me know down in the comments if you are holding, buying, or selling Johnson & Johnson, and make sure to leave a like and subscribe as it really helps me out.